Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. The American economy expanded faster than initially estimated in the second quarter, a 3.3% annualized rate. Now that reflects a pickup in business investment as well as an outside boost from trade. And this news helped to send the U.S. equity market to record highs. However, those gains were to some extent held in check by caution in front of some key inflation data. We'll get the July PCE Friday morning. Core PCE is expected to rise at a 2.9% rate. That would be the fastest in 5 months. And in a moment, we'll get some perspective from the Asia Pacific. We'll hear from Raj Singh, multi-asset portfolio manager at Principal Asset Management. But we begin here in the States, where late Thursday we heard from Fed Governor Chris Waller. He supports cutting interest rates by a quarter point next month, with more reductions likely over the next 6 months. Even so, Waller does think a half-point cut next month isn't necessary. He spoke earlier at a conference hosted by the Economic Club of Miami.
I felt this way in July, and all the evidence since then has led me to feel more strongly about it today. Based on what I know today, I would support a 25 basis point cut at the committee's meeting on September 16th and 17th.
That is Fed Governor Chris Waller there. By the way, he is seen as a potential successor to Fed Chair Jay Powell. Joining us now for a closer look at the Fed story is Alonso Munoz. He is Chief Investment Officer at Hamilton Capital Partners. The firm is based in Atlanta today. Alonso joins us from here in New York City. Thanks for making time to chat with me. I want to begin with the comments that we're hearing this evening in Miami from Fed Governor Chris Waller. He seems to be diffusing the need for a larger cut, but he's not excluding the possibility of a 50 basis point move should the payrolls data come in on the weak side. Does that seem to make sense to you?
Well, Doug, good evening. He really does have to thread a needle, and it's a tug of war for him. The Fed is in a really difficult position because we're getting a mixed bag on economic data, and we're going into a really, really important meeting here in the next couple of weeks, Fed meeting, where the market expects a rate cut. So I think that he's sort of pushing the envelope a little bit. And as you know, we get PCE tomorrow, which is a big data point for the Fed, and we're going to have to see how this plays out going into the next Fed meeting. I think that he's on the right track.
Well, the inflation story, I think, is key. It's interesting that you mentioned that. The PCE data, yes, tomorrow morning for July. After the bell today, we had warnings from both Caterpillar and Gap. Kind of interesting, a big industrial powerhouse and a major retailer, both talking about the headwinds from tariffs. So this could filter through to the consumer, whether it's on the business end or on the retail side, in the near term, which, as you're kind of addressing, could complicate the picture for the Fed.
Well, I think there's even more complication, Doug. As you know, the de minimis exemption runs out tonight. And so consumers potentially are looking at higher prices for all types of goods. And companies are struggling on how to address this tariff disruption issue. And it's something that we're going to continue to watch very closely. On the other hand, though, Doug, when you look at corporate earnings, things still look pretty good. We got a good GDP data. Personal consumption was up. We'll see how personal income and personal spending comes in tomorrow. But that's what makes this market so difficult. And that's why I refer to this tug of war, if you will, where we're getting a mixed bag on economic data. The consumer is still strong, but businesses are saying we have to eventually pass these costs to consumers, potentially raising inflation, putting the Fed and Fed Chairman Powell in a corner as they go into this next meeting.
Speaking of the next meeting, we've got this cloud hanging over it with the attempted firing of Fed Governor Lisa Cook. She filed a lawsuit today. Her lawyers basically saying that the claims that she allegedly lied on mortgage applications really have to do with an unintentional clerical error. And the lawsuit does call this firing an illegal attempt by the president. He's using a phony pretext that doesn't amount to sufficient cause to remove her. Do you have a sense of how this is going to play out? I know you're not a lawyer, but until we get some resolution, perhaps from the Supreme Court, this is going to be an issue for the market, will it not?
Well, it's exactly how you framed it. It's a dark cloud over the Fed, specifically as they go into their next Fed meeting. What we saw, though, from the fixed income markets was not a lot of fireworks. We didn't see big moves on the back end of the yield curve. If anything, we saw a little bit of reprieve today. And the market has shrugged this off. It's another Trump administration move to apply pressure from all angles against a Fed that has been unwilling to cut against his recommendations. And so something that's going to continue to hover over and be very uncomfortable for the Fed as we go into the Fed meeting.
A lot of talk this week about the artificial intelligence trade. We had the earnings from NVIDIA this week, a forecast that basically indicates a little bit of deceleration in growth. And then today, after the bell, Dell Technologies boosted its annual outlook. This company is seeing strong demand for AI servers. I'm curious about how you feel about the AI trade right now.
Well, with the market, Doug, at all-time highs, it just makes you wonder how much this market can power higher, specifically on AI enthusiasm. But when we dig through the numbers, it's remarkable. I know you spoke about Dell, but NVIDIA data center revenue was just absolutely astonishing. And it's something that's continuing to power this market as we look back over the last couple of weeks and months. Earnings from the Mag 7 continue to highlight really strong CapEx, and it's something that can continue to power this AI enthusiasm, this AI trade forward into the back half of this year, and it's something that we're excited about. But again, there's a little bit of caution as we go into the back half of this year that some of these names look a little bit overextended.
So are you expecting maybe a pullback in the next quarter?
Well, Doug, I don't see why we wouldn't. September is usually, at least over the last 10 years, from a seasonality standpoint, not a great month for financial markets, specifically U.S. equities. And so we would have some pause and maybe keep a little bit of cash and dry powder on the sidelines to take advantage of these dips. But over the long term, we're still very optimistic about the AI trade and some of these names that are driving and leaders in the space.
Interesting development today from the European Union. They're going to follow through with the demand from President Trump. They have adopted draft regulations to remove all tariffs on U.S. industrial goods. Now, the bloc is also going to give some preferential treatment to a few U.S. agricultural and seafood products. And in exchange, the European Commission is saying this is going to pave the way for the U.S. to lower tariffs on European cars and auto parts to 15%. I think that current tariff rate is around 27.5%. How are you feeling about the tariff story right now? Do you think that the market is becoming a little bit more comfortable, or is there still so much uncertainty in regard to how this is going to play out that you just want to maybe be a little bit more cautious?
Well, the market has become a little bit calloused, if you will, to some of these tariff moves and tariff negotiations. We all remember April when we were scrambling to sort of predict what was going to happen next. But again, we're not seeing huge, as you noted, huge reactions to either these tariff announcements, whether the president is being more aggressive or, foreign nations are taking some of the heat away from tariffs. So it's something that we're going to continue to watch. But again, we're cautious going into the next couple of months. We're keeping a little bit cash on the sidelines and seeing how this market plays out going into the back half of this year.
Alonso, I'm curious as to whether you're finding opportunities outside of the U.S. right now. Is that a focus for you, offshore markets?
Well, we are right now with all the tariff disruptions and really keeping up with this administration. We're trying to keep our dry powder focused on dips in the U.S. markets. But we are looking at Europe, we are looking at Asia, and maybe India as an interesting market. But right now, we're concentrated here in the U.S.
Alonso, we'll leave it there. Thank you so very much. Alonso Munoz, he is the Chief Investment Officer at Hamilton Capital Partners. The firm is based in Atlanta. Alonso joining us today from here in New York City on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. So as mentioned, all eyes will be on the PCE report here in the States Friday morning. For more, we heard from Raj Singh, multi-asset portfolio manager at Principal Asset Management. Raj spoke earlier with Bloomberg TV host Shery and Avril on the Asia trade.
So Raj, we did see a really solid performance on Wall Street in terms of stocks. Are you looking ahead to the inflation data that's coming out later as something that could potentially derail this?
Yeah, first of all, good morning. I would say that the inflation data, the today's PCE reports, definitely we are not looking for big surprises because we know from the PPI and CPI that how it's going to look like. So in terms of what it means, like for the Fed policy, I think the September base cases, 25 basis point cut, it's fully priced into the market. So what will be more important, in our opinion, is how the next Friday's labor market report looks like, and what will be the CPI reading for the August number, whether we see further signs of tariff inflation creeping into that number. So that's what we'll be watching for. Any big downside surprises on the payroll side especially can boost the case for a jumbo cut. Otherwise, I think 25 basis point is the base case. However, what markets will be looking for will be basically beyond this September meeting, how the Fed policy path folds out. People are looking for 125 basis point of cut in 1 year. So whether the time period really holds up is the big question. And the second, beyond that, I would say the policy aspect, market is really paying a lot of attention to the Fed independence aspects, and any erosion of the Fed independence can spook the markets.
I was just about to ask you, how might the threat to Fed independence, or the perceived threat, actually play out in markets towards the end of the year and going into next year, and might that muddy the waters? Yeah, so I would say it's a two-edged sword. Definitely, as the composition of the Fed keeps changing and the tilt goes towards the dovish side of the things, it will be good for the risk assets. So in general, I would say the risk assets are still looking in a pretty good spot here, despite some of the, I would say, fragility showing up in the economic data, especially on the labor side. But where it can have bigger impact will be definitely on the bond side, and that's where right now the action is happening. The U.S. curve is steepening, but bear in mind the curve is steepening everywhere. So definitely it's a factor. Market is also hooked up, but in a long term, I'm not sure how much impact it's going to have on the Fed policy, because ultimately the Fed is going to be driven by the data, which is labor and inflation, and that's going to drive the policy action to large extent. And despite all the noise we see in the markets, it's highly underappreciated that when you look at the developed market curve, US 30-year is still on a relative basis is the best performing curve out there in the developed market. The German bonds are up like 30 close to 60 basis point. Your JGBs 30 are up close to 90 basis point. In fact, we have seen that movement in China as well. So it's a global phenomenon of that steepening of the curve, but definitely erosion of the faith in the Fed policy can have longer term repercussions, and we will see how that plays out in the market. But it would be mainly a bond market story at the beginning.
Over in China, also a story of tech, because we do have Alibaba, of course, results out today as well. What are we expecting in terms of some opportunities that we could see in that market?
Yeah, so China is a very interesting market, and I would say we have been highlighting it for some time. What you see in China is basically that there are a lot of household savings. So the households are sitting close to, let's say, 19 to 20 trillion US dollar, the deposits. So the household savings are in excess in China, especially after COVID, that savings have built up. At the same time, the policymakers are definitely trying to guide that long-term institutional capital into the market. And the reason for that is that it can act as a catalyst for the economy because of the wealth effect. So in China, I think you may keep seeing this bifurcation between the fundamentals and the market, where the market may keep driven by the liquidity aspect, because the deposit base, the excess savings are quite huge. The bond yields are low, so that's rotation from equities into equities from fixed income will be there. And I think the opportunities lie structurally in the high dividend stocks and some of these tech stocks, so that barbell of tech and high dividend still makes sense to us. And we have to see what happens to this price war on the overcapacity side we see, and market will be definitely parsing through the earnings of some of these tech giants, like how that competition is looking and what it means for the deflation story at the macro side, and the second for the corporate earnings story. And I would say that the earnings so far are a little bit underwhelming, and some of the market rally is driven by the valuation aspects because it's a liquidity-driven rally. But I think tech and dividend stocks are definitely going to be the story in China.
And just before we let you go, credit spreads grinding lower across the world. Where are you seeing the opportunities?
Yeah, I think the credit spreads are quite tight globally, and the credit curves are quite flat. So I think we still like the carry. So definitely at the short end of the curve, we are shifting more from the credit side. And at the longer end of the curve, we are switching the duration to more to the treasury duration, preparing for some of the, maybe we say like the air pocket, which we may see given the uncertainty in the macro data we are expecting on the back of these tariffs and other policies we are seeing from the U.S. administration, and also some of the front loading which has played out so far. Probably it will give back in next 3 to 6 months.
That's Raj Singh, multi-asset portfolio manager at Principal Asset Management, speaking earlier with Bloomberg TV host Shery and Avril Hong here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.